past couple times I've spoken at Cambridge, I was talking about why you should stay calm and buy gold stocks even though they hadn't broken out yet, and even though we were not yet in a gold bull market. We are now in a gold bull market, and so those are the things I want to talk about today. I am Nick Hodge. I run the division of angel publishing called Outsider Club. About 250,000 retail investors on that list. It's free. You can sign up, and then we offer various paid products that really span the gamut of the market, from dividend aristocrats and drips all the way to speculating in the companies that are out in the exhibit hall here. So really cover the whole market with a variety of editors. And then at Resource Stock Digest, I own with a partner. His name is Gerardo Del Real. That's a free website where we try to tell the stories of quality junior companies that we like and have oftentimes taken personal positions in. A lot of times we talk about the reasons why gold was going to go up. That's really all we talked about for the past 5 years, right? Because gold wasn't going up, but we were talking about, debts and the Fed and the printing of the money, and none of that really mattered because gold kept going down. And so I don't want to spend a lot of time on those things today. I'm going to sort of gloss over them. So yes, the central bank bought a record amount of gold last year. Surely they know the fundamental reasons why they're buying gold. They have to have an idea what the end game is going to be. And so it makes all the sense in the world that they would be buying the asset that is going to go up in price as a result of some of their actions. And so, yes, they bought records amount of gold. Yes, the yield curve inverted. That happened as well. That happens before a recession every single time. Sometimes it takes a year or two for that recession to develop, but it always comes. The yield curve has now inverted. Yes, GDP growth is slowing down in the United States. Nowhere near close to 3%. We're looking at 1.5% and 2% prints. Yes, there's record national debts in the United States, some $27 trillion. Yes, Germany's economy is shrinking. It is into negativity for the first time in a long time, printing negative GDP growth. Yes, we have to deal with negative rates, $15 trillion in negative rates now around the world. And let's just talk about this for 1 second, right? Because that's a lot of money. And the entire gold space is like something like the market cap of like Exxon. So at some point that global money, those big funds, they're going to get tired of taking a negative return on those bonds and those treasuries, et cetera, and they're not going to do that forever. And it only takes a little tiny piece of that capital flowing out of those big markets into the gold market to really exacerbate the upside of gold prices and the prices of the equities that produce that resource and explore for that resource and develop projects for that resource. Let's spend a little more time on this chart. This is a chart that Rick Rule's been talking about a lot for the past couple months. It shows the last 40 years of the mining industry through the lens of the Barron's Gold Mining Index. And so, if you circle all the 8 or 9 bottoms on that chart and trace the upside, they have gone up anywhere from 200% to 1,200%. Now that's the gold sector as a group. When it rebounds, let me get out my little laser. When it rebounds, anywhere from 200 to 1,200%, and you can see where we are now from the baseline. We have a lot of upside left here for that 2 to 1,200%. Yes, we're producing gold and we are not replenishing the reserves. This is Marin's chart. It talks about the amount of gold discovered relative to the amount of money spent trying to discover that gold. And it shows that despite spending exorbitant amounts of money to discover new gold resources, the amount of new gold discoveries that we found are going down. And the majors really do need to replenish their reserves. I know this is a common trope in the industry, but it's one of the reasons you've seen the M&A recently, and it's one of the reasons you've seen a lot of companies, do these mergers and acquisitions to consolidate assets and bring new resources and reserves into their coffers. I'll show you the chart in another way. This comes from a Revival Gold slide deck, and it shows the same thing, the production in the blue relative to the new gold discovered in the yellow. And gold ounces have to come online. These majors need to find new ounces. And, we can talk about common industry tropes for another minute or two in that, for the past years, in this 8 or 9 years of resource bull market that we've had, the majors haven't invested in exploration. They just simply haven't. And they've done it by doing JVs or taking 19.9% of another company and doing exploration by proxy. But that's not gonna cut it ultimately. They're gonna have to make acquisitions, and they're gonna have to bring new ounces into their resource and reserve bases. And that is one of the fundamental reasons that the gold price is going to go up. And we can talk about fear and greed. We will in a minute. And that's sort of the cycle we're waiting for, right? For those two things to play off each other. It's what we've been waiting for 10 years now, right? Let's talk about where we are. This is the London fix for gold prices. For a long time, gold tried to break above 1350. It tried to do it in 2013. It tried to do it in 2014. It tried to do it in 2016. It tried to do it in 2018, and it could never get through that 1350 sort of resistance, that bottom red line there. And then in late 2019 and certainly in the early part of 2020 so far, it was able to bust through that barrier. And then you can sort of see the next level of resistance it got to very quickly. And that's where we're sitting at now. That's like the 1560 level of resistance. And so, we had the Iran thing a couple of weeks ago, and that took gold above that. But geopolitical events always have a very, very short half-life. And so gold came right back down, and now it's doing battle with that next resistance line there at 1560. And so that's the level to watch. It's I don't want to say endearing, but it makes me feel good that it didn't retrace more than it did, and that gold is showing strength. It shows me that people want to own gold, and that for the first time in a long time, this isn't a false start. And moreover, I don't think it's a false start because I think this started in 2016. I mean, look at that chart. This gold bull market broke out in 2016. This isn't something that just happened last year. It's just really started to get going last year. So I told you that Barron's mining chart says that the gold sector goes up 200 to 1,200%, and here's the GDX since it started breaking out. The GDX has only gone up 120%. So these are the big ones, right? These are the Barracks, Newmonts, Kirkland Lakes, Kinross's. They're only up, quote unquote, 140% as evidenced by that GDX ETF. So they alone have to double just to get to the bottom of that 200 to 1,200% return, right? And that's the big ones. That's the big global producers. And so I know a lot of people in this room, and certainly myself, I'm a junior speculator, and we've been still sort of like wringing our hands, right? Like, when's it going to be our turn? And I would just reiterate that some patience is necessary, that, this evolution of this bull market is following similar trajectories to past bull markets, and that you see the biggest companies move, and then the mid-tiers on, throughout the trickle-down effect. And in that respect, there's a very much opportunity here to get into these quality junior names, the best seats on the last train out of Juniortown, right? Before that train does leave. Here's that same ETF, that's GDX, and I give credit to David Erfle here, who writes a weekly column for Kitco that I read every Friday, and that's where this was brought to my attention, that this GDX thing is trying to bust through the $30 technical level. And if you trace that back, it's the same thing as gold trying to break through 1350, right? For those 5 or 6 years it was trying to do that. Here you need GDX to break through this $30 technical level, and then we can see the next leg of the gold bull market, right? So that's an important level to pay attention to. Let's talk about what we're here to talk about, the best seats on the last train out of Juniortown and what they have. They have a large economic asset that's in a good jurisdiction, that's run by a good management team, that has a catalyst ahead and a plan to execute on that catalyst and their asset, and a low relative valuation. There's not that many of them out there, folks. This is one I've been talking about for years. Midas Gold, 6.5 million ounces in Idaho. When it comes online, would be the third largest open pit project in the country, behind Barrick and behind Newmont. That's a serious asset. It's currently the 9th largest gold reserve. That's at 6.5 million ounces. It has exploration upside. It's in permitting now, so it's been a long, arduous road for this project to get through permitting. It has been years. There have been delays. It's controlled by the Forest Service. They kept pushing it back. But it's really, really a superlative asset, and the plan that they have is exceptional in that it's essentially a Superfund site, because that's where we mined all the tungsten for the World War efforts. And after that, it was never remediated. It was never cleaned up, and there's all kinds of things wrong. There's arsenic leaching into the stream. The fish passage is blocked, so the salmon can't get upstream to spawn. All kinds of issues at this site that Midas is going to fix as part of the development, right? So they'll, while they're constructing the site, they'll shoot the fish up the stream so they can get upstream. And when they're done, they'll completely remediate the mountainside and the stream so that it's back to the way it was before mining was even there. And so in that respect, they have NGOs and environmental groups on their side, because otherwise this site would not get cleaned up. Let's talk about how rare the stibnite asset is. That's the project that Midas has, the Stibnite Gold Project in Idaho. And look, if you look at this chart here, how many assets there are, 1 million ounce assets, well, there's a ton of them. There's almost 3,000 assets with 1 million ounces. There's, call that 400 assets with 1 to 2 million, 300 assets with 2 to 5 million. You start getting into this 5 to 10 million ounce range, folks, and there's nothing out there to buy. They don't exist. And Midas has one. And then let's talk about the sensitivity, because it's been years since the last time economics were applied to this project, right? I think it was a 2014 study or something. That showed the project was worth just over $800 million at $1,350 gold. Well, guess what? Gold's at $1,550 right now. So we have to talk about sensitivity. And at $1,500 gold, this is a $1.2 billion project. Midas Gold currently trades with a market cap like $130 million. And this is a view of where that asset would fit into the production sort of curve, right? You have like an El Dorado here, producing 400,000 ounces a year. When Midas comes online, that's where it would slide into. Look at the company here, folks. SSR, Pretium, these are billion-dollar companies with a B. And that's the void Midas is going to fill there. So you look at El Dorado, it's got a $1.5 billion market cap. You look at the after-tax NPV of Midas's project, and it's $1.129 billion at $1,500 gold. And they've made improvements since. They'll release a feasibility study this year that will show market improvements from the previous study, whether that's whatever, using limestone on site to grade and finish the roads instead of hauling in aggregate, whatever that is. The economics have improved in the past 6 years, right? And so the NPV and the IRR are going to be higher. You can look for that feasibility study Q2 this year, draft record of decision in Q4 of this year. As I said, this is something that Midas Gold and its shareholders, stakeholders, and supporters have been waiting for years. It's a major catalyst. Again, Midas current market cap, $135 million. Let's talk about Almaden Minerals. Almaden Minerals has a project called Ixtaca in Mexico. It's 4.5 million ounces split evenly between gold and silver. So it's half a silver play and half a gold play. Their project too is in permitting. Albeit currently that process is suspended because there's a lawsuit that cited the way Almaden's mineral concessions were granted. And so it's kind of convoluted. The lawsuit isn't against Almaden, it just cites Almaden in the lawsuit. And so the process is on hold until that will be resolved. But the Mexican president and Congress are on the side, not of the lawsuit, are on Almaden's side. So I believe this is going to get resolved. And so that in itself is, for me, a catalyst, right? Because shares sold off when it announced that their permitting process was put on hold. But I think that's very, very much temporary, and so an opportunity. So let's talk about the project. This is a project that has an NPV of $310 million, an IRR of 42%. That's an incredibly high return. And this is based on much lower gold prices than we're currently seeing. Let's go to the next slide. So at 1125 gold, this is a $150 million project. 1275 gold, this is a $310 million project. And at 1425 gold, this is a $466 million project. Well, certainly we're $100 above 1425 gold right now. And so again, we have to start talking about sensitivity and leverage and upside and re-ratings, right? Let's talk about this mill they bought. They bought a mill several years ago because they knew this project was going to go into production. So they bought a mill in the teeth of the bear market. Like 5 years ago, they bought this mill from Alaska that was only used for a couple of months. Brand new, cryogenically frozen, Morgan Poliquin likes to call it. Bought the mill for $6.5 million. The mill is worth $70 million. The value of the mill is currently worth more than Almaden's entire market cap. They're not getting any value for the project at all. They're getting value like for the mill. It's crazy. They bought that mill for $6.5 million, and that's kudos to the Poliquins for being for having the foresight to do that, knowing the project was going to go into production, knowing the bear market wasn't going to last forever, and using the bear market to their advantage to secure that very critical piece of equipment for their project. So, like I just said, the mill alone is worth $60 or $70 million. And Almaden would need to trade 8 times higher to reach their NPV at 1425 gold, which of course we're higher than now. So you're looking at, that's an 8-bagger there. Catalyst, the resumption of the permitting process. Last one in the last 3 minutes is Revival Gold. This one is also in Idaho. It's a past producing project that was in Yamana's hands. The past producer is called Bear Track. 600,000 ounces came out of that project before the price of gold went to $300 and it was shut down. So right now they've been drilling all 2018 and 2019. They drilled. They put out a resource of 2 million ounces. You can see that there. 1.2 million ounces, just over a gram. 800,000 ounces, also over a gram. And they're due for a resource update. So like I said, they drilled all 2019. By the end of this quarter, Q1 2020, we will see a resource update, probably add something like another million ounces to that project. So you'll have a 3 million ounce project that has, well, I can tell you what they have in a second. But this is the pit shell that they've got outlined here, and what they've been finding over drilling in the past year is deeper intercepts, right? So they're currently evaluating potentially doing a hybrid pit underground model. And I know they're also on the M&A trail as well to bring another project into this portfolio. But we got to talk about the valuation, and we got to talk about what they have there that makes this so attractive. It's trading at something like a $25 million market cap, right? And there's power on site. The leach ponds are there. The ADR plant structure is there. It has its cyanidation permit. Those are milestones that they should be receiving significant value for that they simply aren't. And that's sort of the mismatch in value that I had on the bullet slide a while ago, is what to look for in these companies. So, after the resource update, they'll have 3 million ounces, and then they'll look to tie in some economics on that with a PEA. But let's think about the peer group for a second, and this is something I think I stole from Paradigm, who covers the stock. Their peer group is trading at $45 an ounce, right? And so you multiply that times the 3 million ounces they're about to have, and it should be a $130 million company, $135 million company. It trades at $25 million market cap. I mean, that's just an opportunity, one, but it's a total mismatch in value and what the project has and what the project will be. So you see Paradigm's got a $2.45 price target on that stock based on all the things I just said, and the stock is currently trading at 64 cents. So look, the bull market's here. The juniors haven't gone yet. The majors have. The quality juniors will go. These were some of the highest quality juniors I know and I own. Thank you.